Okay, folks, we have a move and we have a seconder. All those in favour?
Aye.
Aye.
Thank you. Against?
Thank you.
Okay, we'll go to item 16.
Flying through.
Remember they're going to default on the loan instantly, like this week, next week. Do you remember that?
We have Jenny and John.
It's all doom and gloom. They're all down the tubes.
Welcome.
This is the performance report for the final quarter of the financial year. I've got John Bishop here today with me. He's going to do a overview of the Treasury management aspects. I'm going to initially just do an overview of the financial and non-financial performance results.
Okay.
Yeah, I'll share it.
Not working?
Okay, councillors.
Okay. Lovely. Yep. So these are interim results. They aren't audited as yet. We're currently going through the audit process. And they are for the parent, not the group results. We'll bring you back the group annual report next month in September. The first two slides of the report cover off some highlights for the year. The report has got 3 pages of highlights and achievements over the last quarter. Just to mention a few there, we've got the long-term plan adopted, the local board agreements were all adopted for the new year. We've got the new arts facility at Glen Innes. Anzac Day celebrations, we had a huge turnout with the dawn service at Auckland Domain with 35,000 attendees. Matariki Festival, there was a month of celebrations and events that took place. And the Youth Awards took place, I Am Auckland event. Some more highlights, we've had the Victoria Wharf in Devonport that's been completed. Lockdale Precinct Redevelopment Project won some awards at the Institute of Architects. Devonport Library has won some awards at the Property Council. And at the Sulgum Local Government Excellence Awards, we got recognition with the National Environment Monitoring Standards Project. The next 2 slides deal with our service performance delivery. First slide there deals with the activity levels over the last month of December, and we have presented a number of trend graphs in the report around the activity levels over the last 15 months. In the first few categories there, the building consents and resource consents, we are seeing those continuing trends of increased volumes, obviously with our growing city. I won't go through all of them, just highlighting maybe libraries. We are seeing lower numbers in visitors there, but also increased numbers in borrowers with particularly the e-books and digital work that's happening. Call centre numbers over the last quarter were a little bit down, and our service levels did increase during the quarter. The next slide deals with the service performance levels on some of our key areas. All those results there are consistent over the last quarter and achieving our targets. There's a number of appendices in the report. We've got the economic report, some treasury information, there's information on professional services costs, Lagoima information, and customer service information. So just briefly to summarise the financial performance results for the year ended. So our net operating result for the year is favourable. We've got a $17 million surplus, and that was $52 million better than budget for the year. So that was a good, favourable, positive result for the year. We've also achieved our efficiency gains or savings that were budgeted for the year, and those were $20 million for the parent entity. The main reasons for our results, which are better than budget, basically rates revenue was up by $7 million, and our net operating expenditure result was $45 million better than budget, and that's mainly the DFA gains, dividend income, higher user charges, and property income. So mainly in that income space that we had better results coming in. The non-operating result for the year is unfavourable. There's a $186 million unfavourable result. And that's mainly in the fair value of our treasury derivatives. Capital delivery performance for the year, good solid performance here with $455 million of investment completed for the year, and that's an 81% delivery of our capital works program. And that's a much better result than the previous year where we delivered 64% of the capital works program that had been approved. Okay, so just to summarise quickly, net operational result, $52 million better than budget, mainly due to the income side. The efficiency savings gains have been achieved for the year. 81% budgeted capital program delivery. And the debt levels at $6.5 billion are slightly below budget, which was $6.67 billion. So overall, a good, successful year and delivery within expectations. Okay, so I'll hand over to John, our Treasurer, to do some Treasury management aspects.
Thanks, Jenny, and through you, Chair. This first slide here looks at our debt portfolio as at 30 June 2015. And as Jenny mentioned, on a parent basis, our debt is around about $6.5 billion. On a group basis, just over $7 billion. Now, if we first focus on this bottom chart here, the historical funding mix, and if we go right to the left-hand side there when Auckland Council was established back in 2010, that first bar there breaks down our funding mix at that time. As you can see from the blue and the green bars there, our funding was predominantly made up of domestic bonds issued in our own name to either retail, i.e. mum and dad, or wholesale investors. There was a small amount of commercial paper, which is short-term debt, and a minor amount of bank facilities. Now that started to change in late 2011, and the two things which happened on or around that date. The first was the establishment of the Local Government Funding Agency. Now you'll be familiar with that, which gave us an additional source of funding. And the second thing was legislation was passed which enabled the Auckland Council, and only Auckland Council, to borrow funds in offshore currency. So as you can see from that date, we've become a lot more diversified in our funding. So if we go right to the right-hand side of that chart for June 15, and those proportions are reproduced in that top pie chart there, the funding mix, you can see now our reliance on domestic funding in our own name has reduced. Now it's less than 50%, which comes from retail and wholesale bonds and commercial paper. We now raise just over a quarter of our funding from the Local Government Funding Agency, just over 20% from the offshore markets, and a small portion, roughly 8%, comes directly from the Crown, and that's for long-term funding of the electric trains. So the point to take really from this is that we're a lot more diversified in our funding sources since Council's inception, and therefore have a lower risk profile, which is a positive for our credit rating. I should point out that these funding sources all come from the debt capital markets, and it is backed by an $800 million standby facility we have with our relationship banks, and that essentially is something that we would utilise if for some reason all of these funding sources were unavailable to us. If we come on to the next slide, this shows the long-term debt maturity profile for the Auckland Council Group. So on the bottom axis there you see the financial years and the millions of dollars that we have maturing on the left hand side there. Now if I showed you this graph at Auckland Council's inception, you'd have seen 4 or 5 bars at the short end, a lot taller than those ones are. What we've done since then is diversified our debt maturity profile to now what you see there, so a lot more spread across the maturity spectrum. Now if we have a look at those debt maturities, if you first focus on the right hand side of that graph at 2047 and 62, those maturities represent the Crown funding for electric trains, so some very long dated funding. The maturities from roughly 2024 to 34, again those sort of maturities in the range of 10 to 20 years, generally they reflect the funding that we get from the offshore markets, which tends to be longer dated than the New Zealand markets. And the funding from out from 2016 to 2024, again largely, that's the funding we do either domestically in our own name or through the Local Government Funding Agency. Again, what we've done by spreading that maturity profile is again reduced refinancing risk, which again is a positive for credit rating agencies. So So let's now look at the cost of our funding, both going back in history and then looking forward. So we first focus on that top graph there. You can see that green line shows our cost of funds, which has come down since June 2013. And again, that largely reflects the low interest rate environment that we're enjoying at the moment. The black line there represents the budget, and the blue line represents our benchmark. Now that benchmark is essentially the 7-year swap, priced over 7 years each month. So there's 7 times 12 is 84 data points. Each month we replace the oldest data point with the new 7-year swap rate. As you can see, that's come down and has come down very quickly given the low interest rate environments we've experienced in New Zealand over the last several years. Now the obvious question to ask is, why is it approaching the green line? The reason for that is that I guess at council we place a premium on having certainty of our interest costs. Now I'll just give you a sort of example to why we're not all, for example, at floating rates. If you look at the current group's debt of say $7 billion, if that was all at floating rates and in our operating or balanced budget, if interest rates were to go up by 1%, if you do the maths, that would increase interest costs by 70 million per year. If you look at what that would equal in terms of an increase in rates, 1% in rates is roughly 14 million. You'd see an increase of rates of about 5% to compensate for that. So as you can see, and for that reason, especially over the near term, and what I mean by the near term is the next 3 years, especially those 3 years of the long-term plan, we are close to 100% fixed to give us that certainty. And that's very deliberate action that we've taken. The bottom graph there, that represents the cost of funds that we've projected into the long-term plan. And what that shows is it's slowly increasing, and that really reflects the fact that we do expect interest rates to return to more normal long-term historical averages at some stage over that period. But what we do is we do separate out our funding risk, so the actual raising of debt capital, from interest rate risk. So when we do think interest rates are low, we will lock in those interest rates for periods out in the future. We lastly go on to talk about our diversified financial asset portfolio, which we took over from management of from ACIL earlier this year. And that shows the last 5 financial years, the performance against the benchmark. And as you can see, because it's a very well diversified fund, it has pretty well achieved the benchmark, give or take, in each of those years. And as you can see, the last 3 years especially have been some very positive returns, and they simply reflect the fact that the equity markets and the bond markets have generated very strong returns over that period. Now, the way we're operating the fund now is exactly the same methodology that was used when it was managed by ACIL. So the same approach, using a fund advisor, and using a set of fund managers. So the returns since we've taken it over have been absolutely consistent with what you would have seen under ACIL. Let's now open up to any questions.
Very good. Jenny and John, very clear, easy to understand. Councillor Walker.
Yeah, just got a question around our cost of funds. It's really good to see that those those costs are going down. I mean, 5.75%. Do we just pass those cost of funds on in respect of rates postponement, and also schemes like retrofit your home, so that anybody that is effectively loaning money from us benefits from that reduction?
Yeah, sorry, just taking advice here from Matthew. I think for the rates postponement, the cost of funding we use is actually a lot lower. It more reflects our marginal cost of funds, which reflects more the cost of funds, which would raise money at the moment, which is lower than what you'd see.
Lower than this again?
Yeah, because this remember reflects money that the council's raised both in its legacy days and throughout the last 5 years.
Yeah, and I've just got a question that goes to rates postponement. I just wondered if we had any idea as to how many people have taken up rates postponement recently.
Relevant to this?
Well, it is relevant. It goes to our...
Ask if there's a quick
debt.
answer to that.
Not many.
Through the Chair, we have to date, from recollection from the 17th of July, received just under 20 applications for rate postponements. Whether those applications have actually resulted in the rate postponement being granted, I'm not able to comment at this point. The other, just for information to councillors, we've received a significantly higher number of applications for the rate rebates. That is quite a substantial number, and also a very high number of increased direct debits. It's well over 3,000 and heading closer to 4,000 since the 17th of July.
Yeah,